Welcome to today's Canary report. Markets are in a state of cautious consolidation as investors digest mixed signals from the AI-driven earnings surge and weigh their next moves near all-time highs. The Dow's outperformance against the Nasdaq tells us something important about what's driving capital allocation right now, while that gold spike suggests institutional money is quietly recalibrating risk exposure. Let's see what our canaries are telling us. Speculative sentiment shows clear bifurcation today. The biotech sector led the speculative charge, with XBI posting a solid 2.9% gain, while SPHB, the high-yield income vehicle, dropped nearly 3%, indicating that investors are selectively rotating within their risk portfolios rather than broadly expanding or contracting exposure. IRKK and MAGs both held relatively flat, suggesting active fund managers aren't dramatically shifting positions in these thematic vehicles. The consumer discretionary XLY declined modestly at 0.56%, which aligns with the broader tech weakness as capital rotation moves away from growth multiples toward more stable earnings profiles. Credit markets are displaying remarkable stability despite the market's sector shifts. High, HYG and HYGW all moved fractionally negative or flat. No meaningful stress signals here. The fact that high-yield ETFs didn't spike while equity sectors showed divergence suggests investors see credit risk as priced in rather than elevated. This is consistent with the news flow showing AI earnings driving corporate profits without creating leverage concerns. Credit remains a backdrop, not a driver, of today's action. Volatility derivatives are telling us that fear is receding, not disappearing, but retreating to dormant levels. UVXY dropped 2.21%, VIXY fell 1.67%, and VXX declined 1.43%. All three proxies moved in tandem with the broader VIX index, dropping 2.11% to 1581. This synchronized decline across fear instruments indicates that near-term uncertainty is being priced out rather than expanding. The headline about buying VU near all-time highs resonates. Investors are recognizing that despite elevated levels, the AI-driven earnings momentum provides a cushion against typical pullback fears. The real economy engine shows its most telling weakness today in SMH's 4.62% decline, the semiconductor sector taking heat after extended strength. Small caps, IWM, held mostly flat at 0.41%, which is curious given the broader tech drag, and RSP outperformed at 0.75%. KRE, representing regional banks, fell 1.47%, suggesting some concern about commercial real estate exposure as the economy slows. IYT's neutrality at 0% provides a baseline. Famioturing isn't panicking yet. The AI earnings surge Goldman highlighted. 22 Musaeans is helping offset broader manufacturing concerns, creating that classic divergence between headline-making tech and the underlying industrial base. Defensive positioning is showing clear capital rotation without panic. GLD surged 2.12%, while XLP consumer staples gained 1.97%, indicating a deliberate flight to tangible assets rather than a blind sell-off. TLT's near flat, 0.06% movement is particularly telling. Long-term treasuries aren't rallying as hard, suggesting investors see rates as stable enough not to require heavy duration extension. Bonds' modest 0.17% gain rounds out a defensive picture where gold and staples are the primary beneficiaries. This aligns with news themes about hidden costs in income-focused products. Investors are seeking quality defensive exposure rather than chasing yield through complexity. Today's market action reveals capital rotation more than capitulation. The AI earnings surge is anchoring valuations in a way that lets investors selectively de-risk from tech while maintaining overall exposure, creating the Dow-Nasdaq divergence we're seeing. Gold and consumer staples are absorbing defensive demand, while credit remains stable enough to avoid spiking. The real economy's semiconductor weakness shows technology isn't immune, but AI earnings momentum provides counterweight. Investors are in selective rebalancing mode, trimming here, adding there, rather than broad rotation or panic. That's your Canary report for today. The market is breathing easier after that VIX decline, and the selective defensive positioning suggests investors see value rather than danger at these levels. Keep an eye on whether SMH stabilizes. That semiconductor sector could be a leading indicator of broader tech recovery. We'll see you tomorrow.